Hi, thank you. This might be the last panel of the day. I think it's probably going to be the most interesting. I have a fantastic panel joining me here. We have Captain Alok Kumar, Chairman of Alphard Maritime Group. Elias Sakellis, the Chief Investment Officer from Borealis Maritime and Chief Executive Officer from Australis Maritime. Gerbrand Vroegop, Managing Director from ING Bank. Nicolas Duran, Managing Director and Partner of the Investment Banking Division at Fearnley Securities. And John Michael Radziwill, CEO and Chairman at CTM. So today's panel is all about, is the market as good as it gets? I think generally 2024 has been characterized by strong earnings and high second-hand values across a number of sectors in the shipping industry. I actually read a report last month suggesting that for some sectors, the first half of this year showed earnings that were the highest for the past 15 years. But as we all know, when we look across the industry, it is a very fragmented industry. There is no broad brush approach. And when we look at the market, there are so many different factors that can impact it. So just in terms of, before we get into the questions, gauging the stance of the panel, a very quick show of hands, who thinks the market is as good as it gets? Okay, 2 out of 5, so this should make for a very interesting discussion, not quite in alignment there. There's a number of factors, as we've said, that influence the market. Obviously, supply and demand absolutely underpins how the market will shape up for the next 12 months. Nicolas, perhaps I can start with you to talk us through some of the key factors that you think on the supply and demand side will shape the upcoming 12 months.
Yeah, thank you. I think one of the main, call it demand drivers, has been all the inefficiencies ever since COVID and all the geopolitical events that have happened. Those have been very important drivers in increasing ton mile across many different segments and created bottlenecks, etc. So I think that massive value has been extracted by ship owners already as a result of all those inefficiencies. And it's hard to see a lot of upsides from that type, from further events of that kind going forward. I think a lot of people will be monitoring the US elections closely, obviously. I think with Trump being, if he were to win, is a net negative to shipping because of his stance towards China and resolving conflicts in the Middle East and Ukraine. On the other hand, we have a yard situation which is quite unique relative to the previous supercycle. Yard capacity is down 60 to 70% since the last supercycle. And now the entire order book, I'm exaggerating, but most of it is filled up with a limited type of vessel. It's container vessels and LNG carriers for the most part, the type of high margin vessels that yards like to build. And so I think that in the segments where there's lesser of an order book, like in dry cargo, for example, you have below 10% order book, net fleet growth 3% per year over the next 3 years expected. I think that obviously is a very positive signal. So I think it's a bit of a mixed bag. Other things that I've noted down is obviously the long-term demand is there and is positive across all segments. But again, back to, for example, LNG with a 54% order book, it's hard to see that shipyards always delivering vessels on time, or at least for the most part, relative to liquefaction projects that are always delayed. That's going to cause quite a big problem for that market, as we see. I think it's time to go kind of back to basics and look at where there is undersupply. That's where I think I'd rather be in shipping.
Okay. I mean, a few different things that you touched on. Obviously, the elections and geopolitical aspects will maybe come to a bit later on in our discussion. But John Michael, I'm just curious to hear from you. There was a few different things that Nicolas mentioned, didn't sort of talk in detail about, the fluctuations in global trade and commodities. And I'm just curious to hear sort of your thoughts on how you think this is going to impact the market going forwards.
Well, the fluctuations in global trades and commodities impact both the supply and demand of the S&D balance sheet, so to speak, and they can be massive, massively positive and massively negative. Massively positive if they increase ton miles, massively negative if they decrease them. So I think it's a major impact. We have to watch where trade flows are going and never be surprised by a black swan event or a pink flamingo event, i.e. back to normalization that makes rates better. For example, the ending of a war and the rebuilding of the infrastructure that's been destroyed during that war.
Okay. I mean, obviously, a lot of things to take into consideration. You know, I guess maybe a question for Capt and Alok, looking at you. How is it that when you look at the sort of the next 12 months that you think about how do I strategize to try and take into account these different supply and demand factors? Because it's difficult to know exactly how these different things will play out. So what's kind of going through your mind as you're looking at the next 12 months?
For an owner in this kind of situation, there are few levers which you can play with. How you're fixing the vessel for long-term, medium-term, short-term, and spot market. Also, the important part, how you are placed financially, what kind of debt-to-equity ratio you have. And this is how you need to play, and also which region you place your vessel with. Because it always happens, you know, like drag bulk, Atlantic is hot, Pacific is cold, you know, sometimes Pacific. So depending on number of fleet, how you have, how you are positioning the vessel, and if the fleet is larger, you better divide between short-term, long-term, medium terms. So I feel what, as we say, looks everything is going to be great, but as an owner, better to protect yourself, hedge it with long-term, short-term, also looking at your debt ratio. Thank you.
Thank you. And Elias, I mean, Nicolas touched on the supply point and the fact that there's been, you know, across some sectors, some very well-publicized and huge orders going in. I think we've all seen some of the headlines across the legal press. Do you think that there is a risk that in some of those sectors we're going to end up seeing an oversupply of vessels?
Yeah, I don't think it's a risk. I think it's a reality for a lot of the reasons that Nicolas referenced. Obviously, it's much easier and quicker to build a vessel than to create cargo for that vessel. But if you look at also from a historical perspective, when you look at sub-segments of shipping with 50%, 35%, 20% order books, all of which, or the majority of which, is being delivered over a period of 2 to 3 years, it's going to be very, very difficult for ton mileage to counteract that supply. So in the short term at least, those sub-segments will be facing some oversupply. The other thing, which is obviously not nice to read as a headline, is, for example, if MSC is putting a new order for a series of vessels at a yard that was mothballed until a couple of years ago. It was bankrupt, and now it's coming back on stream. And that is also a worrying sign, because yes, shipyard capacity, especially in China, has been coming down very, very quickly over the last 15 years. But that doesn't mean that cannot reverse itself under the right circumstances. Now, the silver lining to all of this, I would say, is two things. Number one, the biggest constraining factor in shipyard capacity, not only in China, but also in Japan, is actually labor. It's not real estate. And that will create a natural buffer in that respect. The other thing, again, and it was referenced very well before, if you're a shipyard, you're actually finding yourself in an environment when you're making money for the first time in quite a while. So you're going to focus on the most profitable and large and complicated vessels that you can build. And so simpler vessels, quote unquote, or smaller vessels for sure, will probably find it harder to find slots, all other things being equal. And so definitely there are sub-segments of shipping that will be protected.
And so, sorry, just to follow up on that, do you think then there's a risk that we're going to end up with sort of a two-tier market where the big names going after the complex vessels are being well serviced, but those smaller companies that maybe have more traditional vessels or fewer orders are ending up falling behind slightly?
Yeah, perhaps. At least, look, a large part of the current order book is being directed by the underlying strategy of the cargo owners or the people who control the cargo. That is not always the case, and there will be speculative orders. Look, you also see it, it's quite amazing actually, in the space of 18 months, the product tankers order book is up to 20%. Surprise, surprise. You know what I mean? So these things can change quite quickly. But generally speaking, I think in the medium term, I would still say that constrained capacity is going to be a friend for shipping.
Okay, thank you. Gerbrand, just looking at it sort of from more of a financing angle, obviously there was the announcement last week from the Fed about the cut in interest rates. How do you think this is likely to affect the availability of financing in the shipping market, and then how might that actually help shape the market over the next 12 months?
I think the cut in interest rates does not so much affect the availability of finance. It is much more driven by the demand of the borrowers. And what I've seen is that the increased SOFR rates have kept those borrowers away from the markets with strong liquidity buffers. So my expectation is if the interest rate curve comes down further, it will increase the demand for financing. If you look at the availability, and I think it was already said earlier, availability is not an issue. What we see is that actually after 2021, 2022, when many operators became net debt free, new entrants came back into the financing market, different type of funding sources, but also re-entries. What we see there is that there is more bank finance and alternative finance supply, and it's only the demand now which is expected to pick up.
Okay. Actually, that brings me on to something that I did want to touch on in our discussion about the sort of the role of traditional banks in shipping. Obviously, there was the article in the Financial Times last week. I think it was ING's chief executive was talking about, kind of focusing on transition targets and looking at the sort of portfolio of clients, and particularly singled out shipping and the aviation industries as sort of areas of concern, that you need cleaner ships and cleaner aeroplanes, and effectively that financing fossil fuel intensive vessels was going to be difficult. And I'm just wondering, is that sort of a signal that traditional banks might end up leaving the shipping industry, or care to comment on what your chief executive was saying?
Well, happy to comment on behalf of ING. Of course, I can't speak for other banks. What the message is we have for our clients is that we want to have a dialogue and understand how they take responsibility for decarbonizing shipping. And we do understand that's not something which happens overnight, but what we would like to see is progress over time. And for those clients who do not want to entertain that dialogue and meet the IMO standards, yes, we will say farewell, because we do have our ambitions and we also have to report how we progress as a bank. But it's certainly not a message that we will exit shipping aviation. It's instead we have prioritized those sectors which are hard to abate, and that's where our attention is, to really understand what our clients do to transition and how we can collaborate.
Okay. And Elias, I know that you also have a sort of debt financing hat, so I'm just curious kind of if you would agree with Gerbrand's view, and do you think there's sort of opportunities for other financing models to come into shipping?
Yeah, so if we take a step back and I try to answer your original question, actually, if it was addressing the ship financing market, my answer would definitely be yes. Look, we are in an environment where a lot of banks that had retreated quite significantly from shipping have come back and are definitely there. You have seen a lot of alternative lenders. You've seen the bond markets. And if you look at the terms of some of these financings, they are truly incredible. I mean, Nicolas and his friends are issuing unsecured bullets in Norway for shipping companies that are yielding 7 to 8%. You know, will it get tighter? I'm not sure it should. You know. So I do think that this is a very, very strong ship financing market, also because of the variety of available sources for financing, which is also quite good. That's what we do, of course. We are also an alternative lender. The only potential devil's advocate thing that I would say would be vis-a-vis the banks is, look, Basel IV, there's no question, it will make it much more expensive to finance asset classes like shipping. And it will naturally not force banks out of the market, but it will naturally gravitate them towards a certain part of the market. And it leaves the rest of the market to other sources of capital to address, basically.
May I comment, because I can't resist. First, I think if you go back prior to 2008, to me it's always a sign when ship finance deals end up in different departments of a bank. Last year I saw the first one in infrastructure. I don't think that's a good idea. I now see in the leverage finance teams, ship finance inquiries coming in. Again, it's a signal. We start to talk about financing cash flows. We start to talk about pipelines, and we've seen it before. It may take some time because the balance sheets are strong of our clients, but ultimately you see that the post will be moved and you commit to long-term structures which may not fit risk appetite. I think the other part on Basel IV, what I've observed is that the returns on ship finance portfolios were comparatively good in larger banks. And what you will see is that the returns might be more normalized, but it will create pressure to look also at alternative banking products to your clients. And I think that is where would historically only be the balance sheet offered a limited ask for cross-buy. You will now see a market which is much more coverage.
Thank you. So I'm just going to take a step back from the financing angle for a second. One of the things that Nicolas mentioned when he talked about the supply and demand was the Trump elections, but obviously geopolitics has a significant impact on the shipping industry. We've obviously seen over the past 12 months, the conflict in Ukraine and in the Middle East has led to a lot of disruption in trading routes. There's also been the ever-changing sanctions landscape that's gone along with it. So I think it's pretty clear that geopolitics does have a very significant impact on the industry as a whole. And I just wanted to get the views of the panelists on a few of the issues arising from that. I mean, Captain Alok, maybe you can kind of talk a bit to how you see geopolitics sort of shaping your business sort of for the upcoming 12 months.
This Red Sea disruption has created a lot of problems, especially for us in the dry bulk market. Initially, when it happened, was a trouble because we had the cargo fixed, and then charters not willing to pay extra arbitration matter. Good for law firms, you know. So many arbitration happened like this. And then when this new things came, especially for Supramaxes and Kamsarmaxes, Panamaxes rounding the Cape, charters thinking it's only 9 days, 10 days additional passage of bunker plus hire, but actually it does not happen because on this route, you cross from northern hemisphere to southern hemisphere, and again you round and come back to northern hemisphere. So you will definitely find a winter in north or winter in south, you know, and then you come Arabian Sea, maybe 5 months of monsoon. So it's not only the time in bunker, but also the weather factor. Normally you take 7 to 8% in that route, but because of this route, the weather factor is about 18%. So initially few months, all the calculation went haywire. So of course, that was a traditional route through Suez, and it was all predetermined. We knew the freight on our fingertips. Again, there is an opportunity. You have the cargo booked and Red Sea opens up, you can make money what you lost initially. But the charter has become smarter. They say, if you come through Suez, freight is reduced by $2. You know? So I don't know. We are waiting for opportunity. How it takes, we don't know.
Thank you. And Elias, is, sort of from your perspective, when you look at some of the geopolitical tensions, how do you see that kind of shaping your business for the next 12 months?
Look, I think in the short term it would be difficult to say that these flashpoints are going to unwind themselves quickly. Even if somehow overnight there were solutions, so to speak, still that doesn't mean that the trade flows go back to normal immediately, and that thing will take time. And if you think about some of the underlying reasons of why these trade inefficiencies exist, I think there is going to be a big incentive from importers to ensure security effectively of imports and not directly go back. So it's very difficult to see this unwinding, and obviously that's hate to say it, but it's good obviously for shipping. There are other aspects which are going to be less positive. Obviously, the West, not only the US, but also Europe, is entering a phase where there seems to be support for a tariff regime of all sorts, and that can also be quite negative. You can think of Chinese EVs and the impact that can have on the car carrier market as an example. So it's not going to be a straight line. It's difficult to predict, but generally speaking, these inefficiencies will probably stay there in the short term.
Okay. And I mean, John Michael, sort of listening to that, are you of a similar view that kind of this is going to continue maybe for the next 12 months? And what sort of strategies can be employed to try and mitigate some of that?
So let's start here. We're in a global business, and I'm sure geopolitics are a huge driver of the underlying markets in our business. Having said that, I think it is very dangerous to try and predict geopolitical changes. So what we try and do is prepare for geopolitical changes. One of the things you can do is always be prepared for the most intolerable scenario that can possibly happen to wherever you're exposed. And if you're able to do that, that frees up, it's really, you think it's constraining, but it's actually liberating in that it frees up a lot of, for lack of a better word, headspace to make the next decision and enhance whatever investment you have.
Okay. And Nicolas, I mean, a bit of crystal ball question now. Elias sort of indicated that in some ways some of this uncertainty could be good for shipping. I mean, when you look at the 12 months ahead, do you think some of this geopolitical instability, is that a benefit or a burden for the shipping industry?
I think the best thing for shipping, sadly to say, is the status quo. There are, of course, like certain segments where there could be another event which is increasing the ton mile even more, like you could have the old Panama Canal constraints coming back, and the LPG shipping trade would go up, etc. So there are examples like that, but overall I would say that the status quo is probably as good as it gets. Hopefully some of these events or conflicts get resolved over time. Like Elias says, it doesn't seem like that's going to happen anytime soon, and even if they are, it takes time before people go back to old trading patterns. But I expect to see status quo for the next 12 months, which means that we'll have these same inefficiencies, keeping the ton mile up across many segments.
Okay. Well, in 12 months' time, we can have this conversation again, and we can see how accurate you were. We talked about kind of, is the market as good as it gets? One thing is on the earnings, the other is on the asset prices. Gerbrand, one thing that we have seen that I think was highlighted in the discussion last week was banks have generally been a lot more conservative in this current cycle compared to some of the previous highs in the shipping market when they're looking at leverage. Have you seen that, or do you think this has an impact on actually constraining some of the asset prices and valuations?
I generally think, and I'm sorry to say that, but banks have a short memory. So yes, if you go back 2016, 2019, the markets, learned a lesson about valuations, and we can all see where container ship prices were. After COVID, no one is talking about 10-year-old Panamax container ships going at 5 million. So, do we see more conservatism? Lenders have not been pushed by borrowers until recently to provide higher advance rates on assets. What we do see is that now, for most assets, we're above average, and if that's by 20-30%, we can debate, but that also borrowers start to push more the advance rate on assets because lenders are keen. And would it be initially price which is under pressure? The next step is the financing terms. And what we start to see, and it was mentioned earlier, non-amortizing debt on ships. And that is a sign to me, again, that gradually we start to take more asset risk and cash flow risk.
Okay. And John Michael, sort of in your experience, do you think that the banks have got any influence on the asset prices, or do you think it's purely driven by the sale and purchase market?
I think the cost of capital absolutely has a big impact on the value of assets. I also think the underlying freight markets have a big impact. And for avoidance of doubt, I think right now in the dry cargo space, you are between 500 to 1,000% away from all-time highs in day rates. So we are prepared for the most intolerable scenario, but we're also prepared for a very good scenario, especially in the 5 to 8-year-old kind of Panamax and down section. So I think that if the banks are there and alternative sources of financing are there and interest rates are going down against what doesn't look to be a fairly compelling supply-demand backdrop, at least for dry cargo, probably you'd be a buyer of assets right now.
Okay. And Captain Alok, is that your perspective? It's a good time to be a buyer?
Different sector, different scenario, you know. But asset price going to remain like this, not coming down for maybe next 2-3 years. Although dry bulk today, asset price in the current charter market, there is a disparity, you know. I feel it's still charter rate has to come up. For a $25 million 10-year-old Ultramaxes, current market is $15,000 to $17,000 maximum. Does not make sense. With $25 million capex, you know, how can you owner make a profit? He's not able to meet the capex requirement. But people have very positive view on that. That's why asset price is high. They are looking at next 2-3 years going to be very, very good. So asset price will remain going up. I don't know. Chances are very, very low. So physical asset investment, I don't think is the right time to go for very expensive dry asset. Tanker, I have no knowledge. That's what I can tell you. Offshore, I trade vessels. I have traded about 60 vessels in last 3 years. Whatever has to go up has gone up. I feel there is still 20% valuation on the current, especially on the PSV, not on the anchor handlers. PSV and PSV is still 20% chance to make some money on that.
Right. So there are still opportunities to make money.
Yeah, but 20% of physical asset, actually it looks very good, but absolute number doesn't make very good. You buy for 20, sell for 24, but out of 4 million, taking over cost, delivery cost, legal cost, eats away your 10% of the profit. So absolute number doesn't make very good sense, and 20% margin. It is 40-45% on investment makes good margin. Thank you.
Well, I'm sure the lawyer's fees were great value. So one other topic I wanted to talk about is the increase we've seen in M&A activity in the shipping sector recently. So over the summer, there was MSC's acquisition of a majority stake in Gram Car Carriers, and also ADNOC acquiring Navigate. Nicolas, when you look at some of this activity, what do you think this kind of tells us about the status of the shipping market and the fact that some of these big names are kind of jumping into some of this M&A activity?
I love this topic because it's kind of pointing in different directions. On one hand, you have used one example with MSC acquiring Gram Car Carriers. Mr. Aponte is known for being a fairly savvy and experienced shipping guy. So for him to go in and pick up a company, a tonnage provider in car carriers at what most people would say is a pretty high point in the cycle leads one to the question whether he was sane when he made that decision. On the other hand, he probably has better insight and visibility on EV exports from China than most other people. So I think that there are a number of drivers today that are somewhat unique. I think first of all, for people who want to make a strategic entry into a sector today, M&A is probably the best way. There's not that great liquidity in the S&P market for modern assets in any of the sectors. If you want to enter a sector by ordering 20 new buildings, I mean, good luck getting 20 slots.
Please don't.
No,
not in dry cargo, at least. We're positive because of the low supply more than anything else. So.
It's almost an impossibility.
M&A.
Yeah, exactly. No, but I think that's one of the few good ways to get into a new sector. There's also been a massive concentration of wealth for private ship owners. If you're a private ship owner and you own 10, 15, 25, 40 ships, whatever, 5, 6 years ago, you're probably struggling a little bit. At the very least, you're feeling a little bit of pain. Maybe you had other investments that made up a much bigger part of your net worth than that shipping investment. Today,
it was painful.
From someone who knows. So if you look at today, I mean, we have examples of ship owners who sell their company or their stake in a company because it's all of a sudden by far the biggest part of their net worth is stuck in that one investment. And if you've been in shipping a few years or decades or cycles, you know that it's maybe not the worst thing to take money off the table at that point in the cycle and diversify, invest in different things, etc. So that's one thing. Another thing is the willingness to pay up for platforms. ADNOC's acquisition of Navigate is a great example of that. You want to make a big entry into a market to try to sort of build what Navigate has organically. Probably takes quite a lot of time, and to build up that fleet also becomes quite difficult. So buying the company instead makes a lot of sense. Lack of scale. There have been a lot of panels discussing the increasingly stringent regulatory environment and the need for decarbonization and fleet renewal, etc. Doing that as a subscale small shipping company is becoming harder and harder. The last thing is with the number of shipping companies that are listed, being a lot of them trading below NAV, as they often do, but recently, even though the markets are doing well, the equities for many shipping companies are trading well below NAV. I think it's seen as an opportunity for many strategic players to make an acquisition, because maybe you can put forward a customary premium and still acquire the company at or around NAV, which is, to be honest, if you're going to go and try and do the same thing in the S&P market, you're going to be driving prices up a lot. So I think those are
That's fine too if it's in dry cargo. We've heard about it.
Yeah, so I think M&A is pointing a bit in every direction. You see examples of people who've not been in shipping coming in and paying top dollar, but you also see people like MSC coming and doing transactions. So it's hard to sort of read any specific conclusion out of it in my mind.
Okay. Elias, I'm curious to hear whether you sort of share the view of what the M&A activity sort of signals in terms of the status of the market.
Look, I was generally expecting myself to disagree with Nicolas. I actually don't, but I would perhaps express it in a slightly different way. Look, you brought up two very good examples, and You can argue that there is a lot of strategic value for the largest container ship operator to look at the next adjacent shipping markets, which is car carriers, and have a different view. And generally speaking, operators view the economics of individual ships quite in a different way than ship owners or tonnage providers. So, okay, you can understand that. You can also understand the shipping arm of a large NOC in the Middle East, whose role in life is to control energy shipping for the parent. And they did Navigate, they did Zacher Marine, they did a lot. And again, you can argue that all of these things have certain strategic value away from pure economics. And then you come back to pure economics, and you stand back and you say, well, where am I buying in the cycle? Put aside the strategic value. And the cash yields are still good, but would you be buying right now? You would probably not be selling, but would you be buying right now? So, and this is the general issue I have with corporate M&A in shipping, is that general rules of corporate M&A do not apply for shipping. There are your operational synergies will take you so far. You will largely, in most sectors, be much smaller than your clients. And so you will never actually have pricing power. So there are many things. And the toughest thing, I'll hand it over to you. And the toughest thing in anybody who's sitting in a capital allocation position, who's made a lot of money in shipping over the last 3-4 years, is to sit on that cash and wait. It's a very, very, very difficult, and we are all probably going to be speaking from experience. Very difficult to do. But as Captain Alok said, that discipline typically pays dividends.
I 100% agree with you. You have to have discipline in coming out of the market, and then discipline, which is much, much harder, especially if you've come out successfully, of going back in. The other thing vis-a-vis M&A, what we do at CTM is we basically give small ship owners, like myself probably, would be considered that, the ability to come into a platform where you have all the synergies of being a big ship owner and the flexibility to bring your ship out if you want to sell it, whatever. So what we are trying to do is to allow ship owners to get the benefits of the synergies of a big M&A transaction, but being able to keep their own ships and not having to dilute their exposure, so to speak.
Okay. Well, it sounds like it's a very good place to be. I'm very conscious of the time, and there's probably a lot of thirsty people in the room, so I'm going to just ask one final wrap-up question from each member of the panel, taking into account sort of some of the different factors that we've talked about that are going to shape the market in the next 12 months. There's obviously other points that we haven't discussed, like some of the environmental regulations that were talked about in the previous presentation. Just to kind of quick fire, what is your strategy to sort of navigate these different factors for the next 12 months to try and make sure your business is as successful as possible? In a two-line answer, please.
Everything is bullish. Play the game, hedge yourself. Whenever everything looks very rosy, something happens, So always hedge yourself.
Always hedge yourself. Good advice. Elias?
Look, any profit is a good profit, and so we will continue, generally speaking, across the board to be net long in our exposures. We'll probably reduce this net long over the next 12 months.
I will keep preaching mandatory slow steaming for our industry, which will lower our costs, be very good for the environment, and also naturally take supply out of the market. I actually think this will happen as we're seeing newer ships that are already coming out of yards derated. But if we have mandatory slow steaming, we can help ourselves on the cost side, certainly, and we can help the environment, certainly, and we might even be able to help the supply side.
Here.
Nicolas?
Well, I think at our firm, we would like to help build and create large investable shipping companies that can raise the amount of capital that's going to be needed to renew the fleet over the coming decades. I think that's no small feat. There's a wall of capex coming. We think that the right companies should be best positioned to do that, and they should be a certain size. So that's what we're going to be doing.
And Gerbrand?
More of the same, I would say. Engage with your clients, provide liquidity to those companies transitioning over time, and stay disciplined.
Excellent. Some fantastic strategies. Thank you so much for sharing that. I don't know if we have time for one or two no time for questions. Thank you very much.